Another trading day, another all-time high for stocks. Volatility, it's cratered. And there is seemingly no end in sight for a bull market that is just shy of 3 years and running. Yes, if you want to get technical, we were in a bear market for what, maybe 24 hours on the heels of Liberation Day? And I'm not sure, even on a closing basis, whether we hit that parameter. So no question, the AI theme is the biggest secular trade in my lifetime. And the investment CapEx cycle that is driving it is creating winners and losers. For every stock like Oracle, which went up a staggering 43% on a single trading day, there is another company whose business model has been disrupted, going from hero to zero in a New York minute. Adding to this euphoric backdrop is a Fed that has finally gotten the message that it's time to cut rates. The question for the next Fed meeting isn't whether they'll cut, but how much are they going to cut? And increasingly, that is looking like 50 basis points. Look, generally speaking, when earnings are rising and rates are falling, and you're not in a recession, the path of least resistance is higher. Look, I'm as invested as anyone, any talking head out there, and I doubt there's an investment theme that I'm not exploiting. But I've been doing this long enough to understand that I'm not alone, and most investors and portfolio managers are as all in as I am. So it begs the question, who will buy my shares when I want to sell? When you're pushing the edge of the envelope on valuation, it's a money runner imperative to argue the other side of the debate, and that's just what we're going to do. Welcome to the Money Runner. I'm David Nelson. There are two secular themes driving the tape, like I said earlier. Certainly the AI trade, the CapEx cycle, and of course the Federal Reserve and the idea that we're at the early stages of a rate-cutting cycle. Yes, we know about the war between Donald Trump and Jay Powell, the firing of Lisa Cook. All of that is Fed drama. Push that aside for the moment. It's very, very clear that the Fed is going to cut rates. We've seen the employment data. That is certainly weakening. We've also seen that the BLS data is suspect. Look at the revisions. Take a look at this chart. These massive revisions, over 900,000 revised down. Any data set with revisions that large is bullshit. It's unusable. No portfolio manager should use it. And yet the Federal Reserve continues to use it. And the BLS continues with a process that was really established in 1915, not 2015, 1915. So we're talking of what, 110 years and no changes to the process? We're still doing surveys? Put it aside. The Fed's gotten the message. Rates are coming down. Look at this probability chart. You can see that it is a lock. The only question is whether or not we're going to get 25 or 50. I think it could go either way. I think we could probably use 50. It's probably what we should be doing. The employment picture is starting to soften, and that's going to likely become the more important part of the dual mandate in the months ahead. Now, picking up on that is, of course, stocks. All right, the stocks have gotten the message. They understand that the inflation data is out there. There's very little data between now and the next Fed meeting to really change the rhetoric that would come from the Fed. So we're getting a cut, and then the question is going to be how many come after that, and the commentary that comes on the call with Jay Powell. But look at the tape on Thursday. It certainly wasn't tech driving the tape. Now remember, I'm recording this Thursday evening, so by the time you see this, it's probably going to be Friday, maybe even over the weekend. So it's not going to include Friday's price action. But on Thursday, industrials, financials up 1.7%, small caps, mid caps, consumer discretionary, all surging. This is the kind of action you need to see to sustain a bull market. Today's price action looks a lot more like a market coming out of recession than going into one. I said we were going to play devil's advocate and take the other side of the debate. So let's do that. The AI fever is very clearly in charge. Every CEO knows he needs an AI game plan. Why? Because he's going to be fired if he doesn't have one. The board has come to him and said, what's your AI model? How are you going to roll this out? Frankly, those who have said they've rolled it out, I doubt it's gone very far. It's probably in its early stages. And for most companies, there's probably no ROI or return on investment. Look at this chart from Goldman. What it's showing you is the percentage of companies who have mentioned AI on a conference call. Now, they're all talking about it. The question is, how many of them are actually getting anything out of it? Now, all of this speaks to the CapEx cycle. Look at this chart on CapEx spending by the hyperscalers. Up and to the right, almost going parabolic. The hyperscalers' CapEx budget is through the roof, and it's still growing. In fact, it's growing so fast, analysts keep getting it wrong. Here's a chart showing in light blue, those lines in light blue, is what analysts thought would be the CapEx for hyperscalers at the start of the year. The dark blue is what it actually ended up being. Right? We really got it wrong. 15%, and I think it was 2024. Let me look at the numbers here. 15%, 2024 grew to almost 55%. I think earlier this year we were looking for 20%. That's now over 54%. Next year they're calling for 18%, 20%. That's likely wrong. This kind of CapEx acceleration, however, comes with a cost. Let's look at Oracle. We all saw the move this week. The stock went up a staggering 43% in a single session, getting close to $1 trillion in market cap. In fact, this market cap went up close to $300 billion that day. Now look, the growth is staggering, but some analysts are saying, where's the beef? I was on the Oracle call, and yes, the growth drivers are enormous. Customers are making orders hand over fist. In fact, I think Sam Altman's OpenAI gave them a $300 billion order. Now think about that for a second. They get a $300 billion order, and the stock goes up $300 billion in a single day. That implies the margins are going to be 100%. For every dollar of revenue, you're going to get a dollar of earnings. There are costs that come with these orders. In fact, so much so, Oracle is bleeding cash. Take a look at the free cash flow. Oracle, this used to be a free cash flow machine, and now they're bleeding cash every quarter because of the investment cycle. I was on the call, and there were two kinds of analysts on the call. Those with buy recommendations, fully bullish, and those with holds, a few sells. The bulls were euphoric, using words like, oh my God, amazing. It was a love fest. On the other side, the analysts weren't necessarily, critical, but they were cognizant of the fact that the company's still bleeding cash. Now, to be fair, years ago, this was the same kind of criticism Netflix got. In fact, I often pointed out, wrongly back then, that the only thing growing faster than Netflix revenue was their debt. Now, that part of it was right. They were bleeding cash then, and I was concerned. But those investments paid off. And for now, investors will give Oracle the benefit of the doubt. But at some point, that revenue has to turn into earnings. The final piece of the puzzle is valuation. And to be clear, valuation alone is a lousy timing tool. You don't get out of stocks just because they're expensive. What matters more is the direction of the fundamentals. You combine rising earnings with falling rates and you're not in recession, you want to be long. But you also need an exit plan. My wife is a great barometer. We sit down in a restaurant and she never sits with her back to the room. And she always knows where the exit is. And you should too. Valuations right now, yes, are stretched by any measure. You can see the PE right now is approaching 12 2021 highs. We know what followed that. Of course, there was a rate hiking cycle. We don't have anything like that now. But again, it's a concern. We're still below the dot-com highs on price to earnings of 2000. And even if we were at that level, I'm not sure that's enough to pull the ripcord, all right? This investment cycle is pretty strong, but it gives you a barometer of kind of where we are. But no, at these levels, any trigger could set off a stampede. Some things to look out for in the months ahead. First, any sign at all that the AI CapEx cycle is slowing. We're still in the early stages of AI, but as this theme plays out, all right, and we go from one stage to the next, and a lot of companies start using AI, and even profitably, the multiples will likely go down, right? 2, the Fed is cutting rates, and that's the good news. The bad news is why. It's getting clearer that the employment picture is slowing and that the data we've been using to judge employment is bullshit. Any data set with revisions this large, like I said, is worthless. Finally, 3, the geopolitical landscape is not your friend. Russia's incursion into Poland, yeah, it might have been a mistake, but it also might have been a probe to test NATO defenses. All I'm saying is that one of the 3 legs of the stool is missing, and valuation isn't there to support you. Like I said earlier, to what my wife does. Position yourself so you can see every thread and know where the exit is. I wanted to close this podcast and at least share with you my thoughts on what we learned this week, the assassination of Charlie Kirk. When it hit me, like many of you, I was saddened by it. I was heartsick over it. Not that I knew Charlie Kirk. I did not. I was a fan, like many. I watched him numerous times. I was amazed at his grace, his intelligence. He was always the guy that you want on your team if you ever were going to discuss something or try to get out your point of view. He was brilliant. And he did it in a way that wasn't bombastic. It wasn't an attack. It was a conversation, and he made it that way. And I think that's what people admired about him, and the millions of fans that he had, and the love that's been sent to him. And I share my condolences with his wife and children, of course. There were many, of course, who didn't agree with him, and I get that. I understand that. There's a political divide in the nation. But once again, we've had a situation where a great leader has been assassinated, killed, murdered. We saw the assassination attempt on President Trump. If not for a turn of the head, he would have been gone. Steve Scalise, and there were many, many more on both sides of the aisle. But it's a sad commentary to our nation that we resort to this ending of life to get a political viewpoint across, and it's obviously tragic. And I just wanted to share that with you and close out the show that way. Thanks for joining. I'm David Nelson.